Hey guys, David Robinson here. Welcome to the Lead Sponsor Podcast. We've got another great episode for you today. Really excited about our guest and his journey. This individual has a background in management consulting, a 20-year career, successful corporate guy who was exposed to the world of real estate investing and actually dabbled in wholesaling and single family investing while he was working in his corporate career. Ultimately was exposed to commercial real estate and multifamily in particular, and made a transition into the multifamily space while he was working his corporate career, has since exited. He's been investing in multifamily for about a decade now. He's acquired over 3,400 units, 17 different projects, and just a real good down-to-earth guy who has some real-world experience both in the corporate side of the business as well as translating those skills and techniques that he learned in the corporate world and how those apply into multifamily investing. So really excited to have Alan Stewart with me today with Sapient Capital Group, Sapient Capital Group. And Alan and his partner Jack are really focused on, at this point in time, A-class assets or core plus assets that are good quality assets in great locations, high quality stuff. And they're really focused on a long-term play of refinance and cash flow rather than acquire, add value, and sell. So a lot of the syndication deals out there are 3 to 5 year business plans, whereas Alan and his partner Jack are focused on acquiring good quality, high quality assets that he calls legacy assets. And their focus is to add value mainly through operations and then refinance and hold long term. And they're based out of the Dallas, Texas area, DFW. He left his corporate career 4 years ago, started getting into the B and C class asset space, and we talk about why he transitioned or why they are transitioning from B and C class, maybe even D class value add deals to the A class core plus opportunities, and sort of his thought process around that, how his investors have reacted to the transition from B and C class to A class. We also talk about what his expectations are on the market moving forward. And we also talk about a very unique strategy that he implemented from a value add perspective, where they actually use some local artistry to paint a mural on one of their assets, one of the most recent acquisitions that they've had on an A-class asset, and the type of impact that had on the deal itself. So really excited about the conversation I had about Alan and with Alan, and looking forward to sharing that with you. So without further ado, Mr. Alan Stewart. Mr. Alan Stewart, welcome to the Lead Sponsor Podcast. I appreciate you coming on.
Thanks, David. Thanks for having me.
Yeah, my pleasure. So I let the listeners know a little bit about your background, how you have sort of started out in the management consulting world, corporate America, and made a transition into the multifamily space about a decade ago. But let's back up and let's talk a little bit about that background and what that transition period looked like for you.
Sure. Yeah. So like you said, I was like everybody else, told to study hard, get good grades, went to college, studied engineering, went straight into management consulting. So I was never really a real engineer. So I spent a 20-year career there and, ended up as a managing partner for Gartner Consulting, running the Greater Texas strategy practice. Work with lots of big companies and definitely understand the corporate. I've got the corporate battle scars to prove it, but kind of what's probably more interesting is in 2001, I went to a conference here locally in Dallas, and Robert Kiyosaki was speaking there, and he was talking about his book Rich Dad Poor Dad, and so that was kind of like, and he was talking about instead of trading time for money, invest in assets to produce cash flow, and so I would say that was kind of the light bulb, the first financial light bulb of my pragmatic financial education. And so then I went on this journey of learning, and took a turn at single family wholesaling, and kept learning, kept going to conferences, and then finally in 2012 is when I got connected with multifamily. And I used to think some rich guy or some big corporation owned multifamily, and it turns out it's people just like you and me that pool their investments together and go buy quality deals. So so it's been a little over a decade. I've been working on it, and I was able to retire from my corporate job just over 4 years ago. So I'm doing this full time, which is a blessing for sure. You can imagine, as a corporate executive, you got a full calendar of all kinds of meetings and stuff. And, so now I own my calendar again, which is excellent. And the other thing I always tell people is, being an entrepreneur in the world, it's been so cool to meet different people from all kinds of backgrounds, and, just with an abundance mindset. And it's just been a real blessing, and really thankful that I got introduced to it, and, got educated and started to take some action. And then, here we are today.
So let's talk a little bit about. I did not realize that you dabbled in. I don't know if it's dabble. Maybe it's more extensive than that. The single family wholesaling fix and flip space. It's not uncommon to see that happen, right? But you've got this corporate background. In the opportunity that I have to interview a lot of different guests, I notice that those with the corporate background seem to transition into multifamily commercial real estate immediately. They often don't start in the single family space. So what was it that attracted you to that single family space? Was it this conference with Kiyosaki that sort of led you down that path? But anyways, maybe just talk about going into that space and then mentally the transition to larger commercial multifamily.
Sure, that's a great question. And had I learned about multifamily earlier, I would have done exactly what you said, was gone straight into that. But I didn't know about it. So at that conference, they're really talking about, single family investing. And so that was the theme. And that's what I first got educated on, and, wanted to get started. And so I did that, and I did work pretty hard at it. I basically created myself a second job. Yeah. I already had a complex corporate job. And so, nights, weekends, early mornings, working on the wholesaling side. And, basically it was very transactional. And, it's not that people don't do well at that, but for me, I was creating another job and going back to, I was really wanting to invest in assets to produce cash flow as opposed to trading time for money. So, once I got introduced to multifamily, saw that these are really businesses that produce cash flow, valued as businesses. And you can get commercial loans, and you can get assets that are large enough to afford professional third-party property management. So you got all this leverage. And so that really spoke to me, and that's how I made that transition.
Yeah. Yeah, it makes a lot of sense. And, with your background in corporate consulting, I'm sure that all of a sudden clicked and resonated with you and has translated very well into how you handle these type of larger commercial deals. So let's fast forward a little bit. Let's talk about what your business looks like today, and then we'll bridge the gap between, that transition and roughly a decade ago to where your business is at today. So tell us what does your business focus on? How is it structured? Tell us a little bit about what you guys are doing.
Sure. Yeah. So, we're based in the Dallas-Fort Worth area, and the majority of all of our investments have been here in the Dallas-Fort Worth area. So we've pivoted from B and C value add into more of a core plus A assets. So, basically our basic criteria is it needs to be a high quality asset that's well located. And when we go to look at this asset, we say, oh, okay, yeah, I can get my head around, this is an asset that I could hold on to for a period of time. So we kind of use the term of, we could see it being a legacy asset. Mm. And so the exit being more of refinancing the properties multiple times to reduce our basis to zero, below zero, and then, start creating, infinite returns and just creating a really high quality portfolio that over time increases, more cash flow, as opposed to, some of the things where I was putting Humpty Dumpty back together again, and really capital hungry properties, and the hold period is really longer. So that's really how our investment thesis has changed over time.
And how is your business structured today? I believe you have a business partner at Sapient. Maybe just talk to us about that structure, roles, and yeah, how you guys organize things.
Sure. Yeah. So my business partner, Jack Langenberg, so he and I are the co-founders of Sapient Capital Group. So, funny story about, Jack, I've actually known him for over 10 years. Interestingly enough, our very first multifamily investment was the same deal, which was a Class C deal in Irving, Texas,
As limited partners, as
as
investors,
limited
or
partners,
okay,
as
all
limited
right.
partners. So so that's actually how we met. But it turned out that as we got to know each other more over time, uh, we we had our daughters were in this father daughter uh, camping program called Indian Princess. He was in a different tribe, but our daughters are a year apart, and it just we had that connection, and over time, get to know each other, and so he had made some of his own sponsor investments as I've done mine, and then over time we decided to combine forces, and so now, and his background is similar. He's a corporate guy, so I went to A&M, studied engineering. He went to Notre Dame, studied finance and Japanese. So he
Hmm.
actually speaks Japanese, which is crazy to me. But he actually lived over there for 7 years, and then he went to Harvard to get his MBA, and so he's been a CFO and COO for several organizations. But just like me, he retired from that and now does this full time. And so the way we break up things, high level is so from his CFO COO background, he's a bit more focused on like the tax and legal matters side of thing, and I'm a little bit more focused on the capital projects, the story of the deal, kind of the strategy, and then we both do asset management as well as investor relations.
And when did you guys come together? I'm assuming you guys, obviously, a decade ago, you guys are investing in the same deal, probably not really knowing that you had, but later, I'm sure, figuring that out. But it sounds like your paths have crossed, but I'm curious about when you guys actually came together and formalized Sapient Investment Group.
Sure. Yeah. So last year we launched Sapient Capital Group, and but it's funny. It's a conversation that's been going on for a long period of time. As a matter of fact, we talked about doing something more substantive about 5 years ago when I was buying another deal in Fort Worth, Texas, and it turned out that he was still in the corporate world and didn't quite have the time at the time. So we decided not to do it at that time. But it's been a long conversation, and I always talk about partnerships of it's kind of like marriage. You need to date a while, uh, getting to know each other before you get married, and so we've done that, and it's just been an organic thing, and we have some core values of getting stuff done and not wasting people's time, and doing work, and even though we're in the co-founders, but we're both willing to do work and get stuff done. So and have open conversations. So that's kind of how it all came together and how we divide things up at the high level.
Yeah, no, that's great. So, all right. So today you guys are transitioning, and it sounds like you've at least taken down how many assets would you describe, or how many projects have you acquired that fit that new sort of strategy or investing strategy of more core plus? Because it sounds like you're making that transition at this point in time. Is that correct?
Yeah, correct. So we bought our first one. It's just coming up on a year ago.
Okay.
Uh, it's in Uptown Dallas, 179 unit, 2016 podium cell asset, right off the highway. Beautiful, beautiful asset. And, it's one of those that, the dirt is amazing. It's,
Mm.
it's, it's never changing. You look at that and it fits all the criteria. It's a high quality asset in a high quality area. We see it as a legacy asset. and it's been great. And then we're working on buying another one that's 240 units in Fort Worth, the other side of DFW, 2019 build, also Class A, same thing. Amazing area, amazing quality asset. You look at it, it can be legacy assets. So, and then from there, we're planning on acquiring in the coming year about 250 million in assets of that type.
Okay. So I think this would be good discussion for our listeners that maybe it's I would say it's more common among newer sponsors, newer investors to really be attracted to the value add space. It's been sort of the theme for the last, decade or so, as more training organizations have come about to really lean into that value add space that provides the best risk adjusted returns. I'm interested in hearing from you your mental shift into core plus, why you did that, and maybe some of the pros and also cons of the transition into core plus versus value add.
Sure. Well, it's a great question, and it's something that's evolved over time. Like you said, we cut our teeth in B and C value add. I mean, we definitely did some hairy deals, putting Humpty Dumpty back together again, and so we understand that very well. Now, and it's in the end, and I didn't really say this, but I'm glad you asked the question about value add, because when we look for a deal, it's the other thing I didn't mention is there needs to be some kind of value add with it. It needs to have, some kind of upside. And so, in the end, value add in the deal comes down to dollars. It's about taking your NOI from this amount to this amount, and so how do you get there? Well, the business plan that we like the best is to buy high quality assets, high quality areas, but where the current rents on the rent roll are below the current submarket by 10+%. So there's usually a story of, why that is. Could be that, it's a out of state, out of country owner. It could be an institution that owns it. And, maybe they're just not paying attention. So, we can go and improve operations, and burn off that loss to lease. Or it could be that there were a lot of deliveries in the area looking backwards, but the deliveries now are done. And so those concessions in the market have burned off. So looking forward, it's going to be great. Looking backwards, those concessions were there. But in the end, just like a quote unquote, I guess, traditional, value add, it's you got to put Humpty Dumpty back together to fix things physically. But in the end, what you're doing is you're doing that so that you can raise the rents, optimize expenses, ultimately increase your net operating income. And so it's really the same business plan. It's just that we're more focused on the operations of it, and there's a story to take the current rents on the rent roll to the current market. So we're not speculating with it. It's just, what does it take to get there, and that's really what we do.
Yeah. Well, and I think there was and still is a fairly good argument to be made that over the last, let's say, 5 years, and even more recently, the last 3 years, as cap rates have compressed, you've seen, where most people have been focusing, or a lot of people have been focusing on value add, deeper value add plays where they had to really go in and have big CapEx budgets to, hit their return profile. There was so much competition in that space that you saw those cap rates compress further and further. Whereas, the core plus, where there's still an opportunity to add value to these assets, maybe it was a little less competitive because people weren't really focused on that. And so the delta between the two, or the margin between the two, was a little bit more compressed than it was prior to. So you could go and still achieve the same return profile on a core plus deal where you're focused on operations, whereas before, that type of return profile was only available in the deeper value add play. Is that sort of what you were thinking during that time?
Yeah, absolutely. That's a great point. So, when I started, there was a difference probably at least 300, if not more, basis points between in cap rate between an A class deal and a C class deal, which is meaningful, right? And here in the Dallas Fort Worth area, and many areas in the Sun Belt say is similar story. It's like 50 basis points difference in cap rates. So it's almost the same cap rate, as there's been a lot more interest in, the investment money in the larger world is always looking for yield, and they're going to get it wherever they want. And so, that's put a lot of demand on, multifamily investments in general. But yeah, so in the end, if we're going to, spend a dollar to go buy some level of cash flow, it'd be nice for that same dollar to basically buy a much higher quality, newer asset than an older one. And you were asking about, cons. And so like, well, why doesn't anybody do that? Well, it's, we've been doing this, just over 10 years, and it's been an evolution, because as it's like, you have to build up track record. And, also when you get in the A space, so then you start getting to your competitors, sometimes are big institutions, right? And the brokerage community that sells the assets is a different brokerage community. And so even though, you might have a track record in what you did before, they're kind of like, who are you? Because they're used to, working with other institutions. And so there definitely is a pretty high bar to get into the game. And then of course, a lot of the assets, just the raw dollar amount is a lot more. And so, that requires, bigger loans and bigger amounts of capital. So again, just the barrier to entry is a little higher, or in some cases a lot higher, or well, from where I started, huge difference.
Yeah.
So.
Well, and yeah, you explained it better than I did, and that makes a lot of sense. I'm curious about the equity side of things. Have you mainly acquired these deals with just your standard high net worth, high income earning, professionals that are investing mom and pop, or have you gone an institutional money route when you've acquired these deals?
Yeah, so our investor base is, I'd say it's something more traditional. It's people that we've met over time. Mm-hmm. When investors have been in, a couple of deals and things go well, of course that brings some goodwill, and they, kind of share that experience, and other, so, it's built up over time. And so, yeah, I would say we've been have more of the, busy professionals. And then also in some of our, other deals, we've had, for example, my son, who's 27, he invested in the last deal I did, which was his first deal. And so he's, just getting started, a few years out of school. And so, we've had opportunities to help people get started from that perspective as well. In terms of institutional money, we've talked about it. And I could see that, say if we did a big fund or something like that in the capital stack, I could see us having some preferred equity, or something like that. We haven't done it as of yet. This kind of goes back to Jack and I's corporate days of, we've worked with plenty of private equity firms, and, you just have to make sure that you're partnering with the right one. And,
right.
Everybody's going to be a good actor, in the transaction. So,
well, and to your point, I've heard recently rumblings of some of these private equity firms, institutional equity, that is really wanting to get out of some of their assets when it's not optimal for the other investors, right? But their appetite for risk is a little bit different than the traditional investor and the operators. So, so I'm sure that there's some pros and cons going that direction. So speaking of, most of your investor base being sort of, the busy professional, high income earning individuals that are looking to, place, small bets on a lot of different opportunities. Have you seen your investor base have you seen any changes in their behavior as you've moved into Core Plus? I know you just acquired this most recent acquisition in the last year. Did you see, as you transition from C and B class to A class, did you see your investors react to the offering differently?
Yeah, that's a great question. And, the answer is some did and some didn't. So, you know, our avatar is really somebody that's, looking to, if you talk about Warren Buffett, says, what's the number one rule in investing? Don't lose your money. So that's number one for us is wealth preservation, but then wealth growth, then looking at tax advantaged investments. And so I'll come back to the tax advantage side because that's really been a big driver, a lot more so in the last couple of years. And then, of course, now people are looking for a way to hedge inflation. So instead of having their money devalue in the bank, put it in a hard asset that's appreciating. So, some of that has changed over time, or actually a lot has changed over time. And yeah, so just kind of like I was talking about, how I grew up in B and C, and now I'm doing A. And so, and talking about that story of like, hey, that an A could be a value add. They could actually outperform, a C deal. So it's every deal is different. But any case, so there has been some education and kind of paradigm shift, with some of our investors, and I would say a lot of them have also shifted from, hey, we were holding deals from 2 to 5 years, in the past, and people have kind of changed mindset of like, if I've got a great deal and things are going well and I can get my money out and cash out refinance, that's a non-taxable event, I'd rather do that because it's now it's like, hey, a deal sells and then they're like, well, where do I put
Where do I go
money
from
now?
here? Yeah.
Yeah, so I would say the sentiment is definitely changed over time, and going back to tax advantages, of course, not to get technical about it, but people talk about how the tax law changed in 2017, cost segregation, bonus depreciation, and so for a lot of our investors, it's the tax advantages have been very meaningful, and a lot of people have been investing more just because of those tax advantages, in addition to having underlying quality asset.
Yeah. Well, and it does take a little bit different of a mindset shift, especially from a sponsor perspective, because, generally speaking, most sponsors win when there's a sale, right? So you have to be taking a very long-term approach and sort of this shift to, how did you put it? Legacy assets, legacy
Yep.
investment. You really have to start to look at it from that perspective, and it may be a slower growth trajectory, right? So there's like I just had another guest on a week or so ago, and they've gone from literally 300 units to 1.5 billion in a 3-year time frame. Well, there's no way they could do that with the strategy of more of a legacy in assets, where they're going in and just because they used the exits of their early acquisitions to fuel the growth of their company. So I'm guessing then that you and your partner Jack have ultimately determined a business plan that's a little bit more holistic in approach and growth. I don't want to put words in your mouth, but maybe give me some thoughts, or our listeners some thoughts about sort of your mindset about investing moving forward and what you guys want to accomplish.
Sure, that's a great question. And when I started, of course, with all investing, it was like, oh, here's better ways to invest your money. And in the beginning, it was just my money, right? Instead of in the stock and bond market. And so that's where it first started. And then so that's where I was thinking. And then as I learned more, I said, oh, well, this could be an actual viable career path for me, as opposed to my corporate career path. And so, started thinking about that. And then especially when I got into multifamily in 2012, I definitely saw this as this is my career path of choice. And, I'm going to focus on, making it possible for me to go full time in it. So, and then now it's like, okay, we are really going from, okay, how does Alan and how does Jack, get out of your corporate jobs and do multifamily full time to, now it's like, okay, when we think about legacy, and we actually use the term legacy not only for assets, but, that's one of our missions of creating legacies, for other people, through strategic investment in real estate. And so, that's kind of the premise, behind it. And so we're definitely long-term focused, and, as I've learned more, I've realized, okay, well, I'm not really inventing any wheels here. So if you look at, people that have been doing this 20, 30, 40 years or longer, it's like, what do? They buy quality assets in quality areas, hang on to them, and, they're building, legacy, over time. It's not something that happened overnight. And so I do think that, being a patient investor is always wise, because, say, we've had some turmoil in the last, couple of years. And, if we rewind the clock back, 2.5 years, nobody saw a pandemic coming. And then when it happened, we were all scared. Was anybody going to pay rent? And then, here we are today, and, the market in the last year has been just absolutely crazy. And who would have thought of any of that? But point being is that the patient investor, that's focused long term, these are just little blips, in the road where everything overall is going up, right? Mm-hmm. And so point being is sometimes I feel kind of dumb that I'm like, oh, well, why didn't I figure that out, before? Because it's not like this is, new information, but, in the end, it's, that's just these light bulbs that go off over time. And so, yeah, I think long-term patient is good.
Well, and that's a good segue into this conversation about what's happening in the market today. We're recording this, mid-late July. Obviously, interest rates have skyrocketed and are likely to continue to go up in the near future. What kind of impact has that had on your business as you're out there hunting for deals, and what's sort of what's your just overall thesis on how you're going to navigate these waters over the next, let's call it 12 to 18, maybe 24 months?
Yeah, it's a great question. So yeah, we enjoyed historically low interest rates, for a few years. LIBOR or SOFR being almost zero. That's crazy, but we all kind of got used to that. And obviously they're going up now. We've got inflation, and so it's funny, going back in time. We pretty much only did, fixed rate agency financing like Fannie Mae, for example. And, at the time we're like, oh, well, yeah, we want to have fixed rate financing. So if something happens, we can ride it out. And then as rates fell, our yield maintenance prepayment penalties went through the roof. And so, back when we did the loans, we thought we were so smart. And then, a couple of deals we sold, we had to pay some pretty big prepayment penalties. And we're like, oh, that fixed rate, who wants fixed rate? The floating rate is much better, cheaper, and go buy a rate cap and you're good. And, that's exactly, so the last deal we did buy on a floating rate and bought a rate cap to hedge the interest rate. So, keep it in, guardrails, but then, we have flexibility on refinancing that loan, whether it's from a sale or just purely refinancing and holding it. So that's a lot of things to say. I still think that floating rate can be really good. That's actually another thing that's been really interesting is once you get into these larger deals, you have other sources of debt, life companies and other institutions. and they may have a threshold of say, 50 million or 80 million or 100 million in loan size, because to them it's the same amount of work doing $100 million loan as opposed to $10 million loan. And so they do that, and then they also will give better pricing
Mm.
on larger deals, as well as you have more track record. Um, so point being is that everything's not equal, and at the same time, right now, there are some life cos and some other institutions that are offering fixed rate financing that say might be 5 to 6%. And if you didn't have a better floating rate option with some guardrails, in the short term being 2 to 3 years, that could be a good option. And I would just still caution everybody, just if you're going to go that route, just make sure that you have a flexible exit, maybe a step down prepayment or something like that, because yeah, the fixed rate loan might be seem safer, but then if your business plan is to sell in a couple of years and you have that prepaid penalty, well, if you figure out what that money actually cost you, it might be 20-30% as opposed to 5 or 6.
Right.
So that's what I would say there is every deal's different. Keep your options open and make sure your exit is flexible.
Yeah, love it. So moving forward, what's on the horizon for you guys? Do you see yourself, if you are you looking at anything that's in that B and C class range? Or are you only looking for A class at this point in time? And yeah, more than anything, I'm curious what's on the horizon for you. What are you guys planning on executing on moving forward?
Yeah, for us, I mean, we're definitely focused on the A class side. Primarily in the Texas Triangle, with DFW being our home market. So that's our primary focus. It's always nice to be able to get in the car and be able to drive to a property and in 30 minutes. Going back to I like the capital project side of things, the design, figuring out things is even if you're doing A class property, like we just did this really beautiful mural on the one we bought a year ago. And so, it went from this A class property. I mean, just this A class property. So now it's like a Dallas landmark that you can see. And so, just kind of being able to be creative around that and design. And so, we see us being a differentiator of just really acquiring, again, very nice assets and areas and people that, not only we as investors, be proud to own it, but the residents would be like, oh yeah, I live in that building. So that's kind of what we're primarily focused on. But, I always say never. And so, from time to time we have opportunistically looked at some B deals, but again, quality asset, quality area. Sure. Again, it would need to be something that, we would see that we could, potentially hold, longer term. But I say never, because I remember, years ago I said, oh, I'm not doing another deep value add deal. And, I guess they just came and found me. But that's our focus. And, opportunistically, we will look at some other things.
Got it.
And, looking forward, like you said, is, I can even see us, longer term getting into some development strategically. So that could be on the horizon. We have some discussions. We're not there yet, but it's an exciting time to be here in the multifamily market.
Yeah, for sure. Well, I want to start winding down here. I've got a few final questions as we start to wrap up, though. The first one is, what's the biggest challenge that you're facing right now in your business that we could all learn from?
Sure. Well, on the acquisition side, the biggest challenge is the debt market here, and in the very, very short term. I don't think this is going to be a long-term issue, but since things have changed so rapidly, there's just been fewer lenders in the market. So you just have to be a little bit more, what's the word? little bit more, can't think of the
Flexible,
word, persistent.
persistent.
Persistent. That's what
Yeah.
I was wanting to say. But that's a short term thing, but it's a
Mm,
real thing right now that people are dealing with. And so, I just make sure that you're working with great mortgage brokers, have great relationships. Don't discount local banks, because local banks have their own balance sheet and they can lend off that, which is much different than say a debt fund that's trying to securitize a loan and sell it off to the market. So that's one thing. Um, you know, One of the things that's always been a challenge is the operations,
mm,
and so we've always been very, very involved in the asset management side. I mean, we do use third party property management, but you kind of have to inspect what you expect, and found that especially like setting rents and setting renewals and things like that. Um, you know, Now there's some tools. For example, some of the revenue management tools that you can buy now to help with that. Because basically getting people to go be doing market surveys on a regular basis, get out of the office and go do them, and that's easier said than done in
hmm.
as a practical matter, and especially as rents are going up, you want to be there. The point being is some of those tools are helping, but they only help when you for the right market where there's enough data
Right.
to really make them work. Otherwise, they could go the other way.
Yeah, absolutely. What's something that you're just absolutely knocking out of the park right now in your business that you feel like we could learn from?
Well, I would say what we just did, from a design perspective. Um, I'll just tell a story. The same deal in Uptown Dallas. So beautiful deal, and 2016, and so really leveraging design, and we invested in getting some help from an architect and actual designer to give us some thoughts, and the thoughts came from boutique hotels.
Hmm.
And so we knew we wanted to get some new ideas, and we were willing to pay for it because we thought there was value there. But I'll just give you one example. Um, from a practical matter, we had carpet in the hallways, so it's
Hmm.
all interior, podium style outside, air conditioned hallways, and it was time to change the carpet. 5 years old, and so originally we're just kind of like, oh, what color carpet should we change to, right? Well, from a design standpoint, our designer came up with this really cool idea of four different colors of kind of concrete toned, very large vinyl plank,
Hmm.
and put it in a herringbone pattern. And then also we changed the paint in the hallways was kind of this mint green, and changed it to three different colors on the three different walls. And then we changed the color temperature of the light and the brightness. And so in the end, it was like night and day difference.
Hmm.
It made it be just like a hallway to like, oh, it's almost kind of like a piece of art to some
Hmm.
extent. That might be a little bit of a stretch, but I mean, comparatively, yes. But where's the value in that? Well, for example, we were pushing renewals, up to 30% of that property, and new lease trade outs at 50%. And what I really wanted to harp on was the renewals. So we're going floor by floor, 6 floor building, and somebody came in for a renewal, and we're like, yeah, we don't think we're going to renew, and they're kind of like, well, why not? And like, well, we see that you're doing these upgrades to the other floors, but not to mine. So I don't see the value. And they're like, oh, we're definitely doing it for you. Just haven't got there. And they're like, oh, great, I'll sign. They signed up, for
Hmm.
a 30% increase, and then they brought some friends, along with them. And so point being is um, it all goes back to the investment in design. So I think that um, getting some fresh ideas and design can really help the value, because if you're increasing rent, and our average rent there is like 2,000 a month.
Mm,
So you a back of the napkin, increase in value on the property. I mean, it's big. So
yeah.
that's something that we just did last couple months, and it's we're going to do more of it.
I'm curious, and this is an interesting conversation, and we probably should have had it earlier. But if you have a couple more minutes, I'm curious. Did you end up going for the mural on the exterior? Did you end up going with like a local artist, or how did that come together?
Sure. Yeah, it is a local artist, and the way that we went about that was actually another friend, another multifamily operator, and he had just gone through an RFP process to do a mural on one of his buildings, and I really liked the work, and so that was just one of the people when we were reaching out, and because we kind of went through our own selection process of local folks. But when I got to see all of his work, and then I met with him, super super cool guy, really really talented, and I had this we had kind of this idea of what we wanted to do, and something geometric and making it pop and making it a landmark, and he took that and then put together a rendering of took those ideas, and we refined it a little bit, and yeah, I mean leveraging these people that they're artists. I mean, they have this amazing talent and experience. It's worth it.
And so two corporate guys that have transitioned into multifamily who are taking risks on local artistry on their, multi-million dollar multifamily buildings. That's an interesting, process, right? Because most guys that are coming from that corporate background, or even just in multifamily in general, think, very nuts and bolts, the numbers, bottom line. And so, was it a challenge for you to sort of sell your partner and yourself on this idea of investing in this type of maybe a little bit more aggressive approach to adding value to the building?
Yeah, that's a great question. So Jack's completely on board. I mean, he thinks it's cool, but then more than that, we see the results, in the dollars, and so like, okay, yeah.
Is there risk involved with it? I mean, is there a bit of risk because I mean you're putting something in there that's, I mean, I guess it can always be repainted, but was there concern about risk in that? Hey, maybe people won't like this.
Well, yeah, that's a great question because, for example, going back to the hallways, I had a concern, going from a carpeted hallway to, a hard surface hallway, is it going to be too loud?
Mm-hmm.
Are people not going to like that? What's the reception going to be? And it turned out that there wasn't a concern at all. And actually, everybody likes it better, we have valet trash in the property. So, with something still a little bit, yeah, it ended up being like, not only from a design standpoint, looks really good, but also from a practical standpoint, way better. But yeah, I mean, when we originally went to it, like I said, I was a little concerned with that, but it's been received really well.
And it sounds like you see yourselves, executing on that type of strategy moving forward, maybe doing some unique things to your projects that could give them a little bit of pop or distinguish them amongst, all the others that are out there. Is that correct?
Yeah, absolutely. Because, in the end, it's if somebody is, a prospective resident is looking at different properties, what if all things being equal, what is that little edge that they find valuable and they're willing to pay for? And so the other thing that I didn't talk about, but we've been implementing smart technology in our buildings, as well as implementing our own gigabit Wi-Fi throughout.
Mm.
And again, why would we do that? Well, it's because it's an amenity that our residents want to have and they find valuable and they're willing to pay for. And I mean, even in the the A space, right now, there's not many properties that that have it yet. 5 years from now, I'm sure it'll be table stakes, but
Sure.
right now it's a differentiator.
Yeah, that's great. Well, look, Alan, this has been a great conversation. I've kept you a little bit longer than we had planned, but I appreciate you being willing to share your insights, what you've learned over the last decade. Prior to that, going from the corporate world into just the real estate world in general and investing in general and becoming exposed to commercial real estate and multifamily, diving headlong into that, ultimately exiting your career and forming your more formal business with your business partner, and excited to see what you guys do moving forward. What's the best way for our listeners to connect with you, learn more about what you and Jack have going on?
Yeah, I would say just check out our website, which is sapientcg.com. And I'm sure you can put that in a link, or I can spell it real fast.
Nope, I'll have it down there. Sapient,
right.
SAPIENTCG.com.
Yep.
There's a link in the show notes, so go right down into the link right now. If you've enjoyed our conversation with Alan, click on that link, learn more about what he's got going on. And Alan, again, thank you for coming on. Thanks for sharing your story with us and some insights about what's going on in the market, and look forward to chatting with you again soon.
Great. Appreciate it, David. Thanks for having me.